Hi, everyone. I am going to dive in to basically the intro to accounting stuff. If you watch these videos, they will help you with any of the first week assignments that you might come across. Um, and they're also going to help you with the introduction to accounting. I know there's a lot of videos already that are presented to you, a lot of material to read. I try to focus my videos directly on the explicit stuff that you would need to succeed in this course. So if we're looking at the modules, a big thing that we're going to have, vocab, I'm not going to talk about, it's something you could read and do on your own, introductions. I'm going to look at account classes. So I have this file which I'll share with everyone. I call it a cheat sheet. It's my Principles of Accounting 1 cheat sheet. And for now, for this week, the only useful part of it is this top part where what I have is the main account classes that we are learning about this week: assets, liabilities, owner's equity, revenue, and expenses. Okay? Assets are any resource a company owns that they expect to use to make money in the future, to receive money in the future, or is actually cash today. Um, Liabilities are any debts that the company owes. So whenever the company owes someone else money or they owe them some kind of service or product, that's a debt. It's an obligation. Owner's equity is the difference. So when you have all your resources minus all your obligations, you're left with your owner's equity. Revenue, think of revenue. Whenever you earn money because you sold someone something or you provided a service, that's revenue to you. That's your income. Expenses are whenever you have to pay for something that you need to use for your business that you have to pay for. It's an expense. Think of your own bills. Think of when you have to pay a utility, the heat bill. That's an expense to you. Okay. So this cheat sheet, what it does is it, I'm just gonna make sure I'm not muted. Good. Is it outlines some sub accounts that you would find in all the big accounts. I say some because there are thousands of different accounts you could come across. Okay, this only has a highlighted few, but these are going to be some of the main ones you see going forward in this course, at least for the first few weeks. So if you look on the assets, like I said, assets are any resource a company owns. Cash is a resource. You could use it to buy stuff. It's the biggest resource there is. Accounts receivable is a type of an account that it it represents someone owes you money. Okay, so you sell someone a good and they don't pay you in cash right away. They say, I'll pay you next week. So you recognize an accounts receivable. Okay, it simplifies that you're going to receive money in the future. So that's an asset, it's a resource. In the future, accounts receivable, someone's going to pay you money. Supplies are a resource. You use them in your business. Whatever the supplies are, whether it's paper, paper clips, pens, pencils, anything, it's a resource for the company. Prepaid insurance, any type of prepaid account is an asset. So what it is you're prepaying for something that you are supposed to pay for in the future, but you're paying for it now. So the theory behind that is that you are saving yourself from having to pay for it later on. Okay, you're paying for it all at once now. So any prepaid account you see, prepaid rent is something we see in some of the homeworks. That's an asset. Land is an asset. Okay, it's a resource. You could use land for whatever you want. Equipment of any kind is a resource. Okay, you could use it for anything. Let's go down to liabilities. Accounts payable. Accounts payable is the opposite accounts receivable. Accounts receivable is when someone owes you money in the future. Accounts payable is when you owe someone money in the future. Okay, so it's an obligation. You're obligated to pay someone money in the future. Maybe you bought something and you didn't pay for it up front. You're going to pay for it in 2 weeks. That's an accounts payable. So it's a liability, it's a debt. Unearned rent. Any type of unearned account is basically an unearned revenue. What it means is someone paid you money, but you didn't provide them anything. So if someone pays me cash today, but I don't sell them the good that they want, I say I'm going to sell it to you in the future, that is an unearned revenue account. Okay, so it could be for anything specific. Unearned rent would be if someone pays me money today and they're going to rent my apartment next month. Okay, so I'm not giving them anything today. They're not getting my apartment today, but they're paying me today. So it's an obligation that I have to let them use my apartment now next month. Owner's equity, specific owner name. So this one, the example is Chris Clark. The owner of the business, they would have their name there, capital. Capital is what is left over for them to take out of the business. So it's whatever that owner has that they could just take out, almost like a bank account, and use. It's the difference between assets and liabilities. Chris Clark Drawings recognizes how much the owner actually has withdrawn up to this point in time. Okay, so that's what a drawing account is. So as the owner takes out money, they increase their drawing account. Okay, it's a type of equity. Revenues, fees earned is listed here. You're going to see different things. Fees earned is service revenue. So when you provide a service to someone, if you go and mow someone's lawn, that's a service. You're not providing them a good, you're providing them a service. So fees earned, you can word it service revenue, you can word it services, but revenue accounts, anything that makes you earn revenue. So when you provide a service or you provide a good. So sales revenue is when you sell merchandise. Okay? Expenses, anything that's an expense would fall here. So when you pay employees their salaries, a wage expense, an expense. When you pay someone and you purchase supplies, supply is expense. When you pay someone for the rent bill, rent expense. Utilities, utilities expense. Miscellaneous is for like little expenses you hit here and there. But whenever you see an account, so when you're doing the assignment account classes, and you see the word expense after an account, it's an expense account. So when you're categorizing these, try to use this to refer back to and just think to yourself, assets or resources, liabilities or obligations, okay? Equity is everything left over. Revenue is when you earn money for something you did. Expenses are when you pay for something you did, okay? Or you incurred something. All right, so that's the first part. The next main part of this module is the accounting equation. So the accounting equation is assets equals liabilities plus owner's equity. All right? This is a fundamental equation. What this equation is a way to help the company stay in balance. After everything a company does, whenever they receive cash, whenever they make a sale, when they update all of their balances in these specific accounts, and then they update the balances of the total account, so total assets, total liabilities, or total owner's equity. Assets should always equal the combination of liabilities and owner's equity. So let's say this. So let's just say a company has assets that equal $150,000. Then they have liabilities that equal $100,000. And then they have owner's equity that equals $50,000. Okay, if we were to put this in this right now, assets of 150 equal liabilities. Oh, come on. Liabilities of 100,000 plus owner's equity of 50,000. Okay, put that in dollars. Does 100,000 plus 50,000 equal 150,000? Yeah, it does. 150,000 equals 150,000. So this is what the equation means. They have to always equal. So now it could be a little more difficult. Say the problem gives you this. Assets are 150,000, liabilities are 100, owner's equity is 50. And then they say a few days later, assets increase by $25,000. Liabilities increase by $25,000. Well, now what we have to do is we have to see what happens to the balance here. So assets are increasing by 25,000. So assets are now $175,000. Okay? Excel's not working with me today. Liabilities increased by 25. So if they were 100, but now they're increasing by 25, they're going to be 125,000. Plus, it didn't say anything about owner's equity. So owner's equity stays at $50,000. So now $175,000 in assets. Does that equal 125 plus 50? Yeah, it does. 175. So the left side has to equal the right side. Now it could also tell you only limited information, and I think that's part of what a homework assignment is this week. It might tell you assets are 200,000, liabilities it doesn't give you, and then owner's equity is 75,000. And what it wants is it wants you to basically do algebra and figure out what would liabilities be. Okay, so assuming this equation always matches, so assets has to equal liabilities plus owner's equity. If assets are 200,000, liabilities, go back to algebra, you can make it a variable, put it as X plus owner's equity, which is 75,000. Solve the equation, subtract 75,000 from this side, subtract it from this side, and you'll get X has to equal $125,000 to balance. Take advantage of the following fact. Some of these assignments, the account classes, and I believe solving the accounting equation, let you do it multiple times, and it takes the highest score. So don't just do it once, struggle with it, get a bad grade, and leave it. Do this 10 times, the accounting classes, if you have to. Do solving the accounting equation 10 times if you have to. The one that you have to submit, preparing financial statements, does not allow that. It's one that you have to upload and submit. Now, there's something I want to tell you for this. I personally believe this assignment is a bit hard for the first week, but I'm going to try to break it down for you. Okay, I'm going to break it down more than I should. Here's the assignment. I'm not going to plug anything in. I'm going to show you and talk through it. This is a good way for me to see who's going to watch this video too. Okay? A company normally has this, okay? They'll have all of their specific accounts. So they're not going to just have an asset total. They're going to have cash. They're going to have accounts receivable, supplies, equipment, okay? Their assets. They're going to have accounts payable, their liabilities. Common stock is a type of equity, okay? It's a type of owner's capital. Retained earnings are another type of equity, okay? Owner's drawings, other type of equity. Consulting revenue, any type of revenue, however you specify, if it's a revenue account. Expenses, however you classify them, salaries, rent, they're expenses. Now, what this problem wants is it wants you to build the 3 financial statements. The income statement. Income statement shows you a company's net income. Net income is revenue minus expenses. Okay? So on the income statement, you should only put revenue accounts and expense accounts. I don't want to see any other type of accounts there because they wouldn't belong. And what you also want to do is you want to list them individually, okay? So what you would do is under revenue, you would put rental revenue, $17,004. Then you would do consulting revenue, $45,200. You would list them individually, and then you would total them and get the total figure. Do the same with expenses. List the specific expenses. Don't just total them, all right? So in Excel, you'll have to make a few more rows so you could fit these in, okay? And then your net income is your total revenues, so only your revenues, minus your expenses. On the statement of retained earnings, what it does is retained earnings is the corporate form, a public company form of owner's capital. And what it does is you take beginning retained earnings. So beginning retained earnings means what was the balance at the start of the year, okay? So it would be this, because this is the end of the previous year, so it's the same. So 15,900. You would add your net income if you had a net income up here. If you had a net loss, you would subtract the net loss, okay? For this one, you're going to take the beginning capital, the beginning retained earnings, You would add a net income. Then you subtract any owner's drawings. So you see there were owner's drawings here. You would subtract that. So when you take your beginning retained earnings, add net income, subtract owner's drawings, this equals retained earnings December 31st, year 2. This problem has an error where it shows retained earnings December 31st, year 2 of 7,200. Ignore that. Do not put this figure down here. Do not put it there. Do not think it just goes there. Because you're going to see when you use beginning retained earnings of 15,900 and you add the net income you calculate up here and you subtract owner's drawings, it's going to be a different figure than 7,200. So I am telling you, this is going to be how I know who watched this video, who did. Do not put this figure anywhere. $7,200 does not belong anywhere in this assignment. Okay? Do not put it here especially, but don't put it anywhere. On the balance sheet's purpose is a fancy way of showing you assets equal liabilities plus owner's equity. What it does is it breaks down all the assets and then totals them, breaks down the liabilities, totals them, breaks down the equity accounts, totals them, and then shows total assets should equal, this number should be the same as total liabilities and equity. So when you're doing this problem, your asset accounts, use this little cheat sheet, look at what the problem gives you and match it up, but also think to yourself, what is a resource to the company? Cash is a resource, accounts receivable is a resource, supplies are a resource, and equipment's a resource. So you would list them individually, cash, accounts receivable, supplies. You're going to need to make more rows. Don't think that the rows they give you is all you need. You'll have to make more. Then look at what else you have. Accounts payable is a liability. So make a row, put accounts payable, recognize it as a liability. There's no other liabilities. Under total equity, this is important. Common stock would go here. Common stock is an equity account. It's not on the cheat sheet, but it's an equity account. I'm telling you. The only other thing you put on the balance sheet from the equity account is the ending retained earnings figure you calculate up here. Owner's drawings is an equity account, but you are already including it in this calculation. So all you have to do is take the ending figure that you calculate, again, not this figure, not 7,200, the ending figure you calculate, and common stock. Those are the only equity accounts that belong here. Then when you take total equity and you add it with total liabilities, this figure should equal this figure. Okay? Now this is way more than I should have given you guys because it's really walking through the assignment. But again, I think this is a rough assignment for the first week when we don't know too much about accounting. But please watch this video. I'm saying this, if you're hearing it, you are watching the video, so there's no point in me saying it. But go through it, use it to help you, take your time, take advantage again. Account classes and the accounting equation, you could take these many, many times. The whole point of this real first module is to show you assets equals the combination of liabilities plus owner's equity. If you're confused about what makes up assets, use the cheat sheet. But remember, they're resources, liabilities or obligations that you owe, debt you owe. Owner's equity is leftover, the difference. Revenues are when you earn money. Expenses or when you have to pay money for a certain benefit. Okay, I'm going to end this video. I'm going to end it here so you can see this cheat sheet. Okay, you can pause it here when you do your work. All right, questions, let me know. All the best.